Let's begin with a story that might sound all too familiar to anyone who's ever filed taxes in America. Meet Sarah, a talented graphic designer from Ohio, who juggles multiple clients and deadlines from her cozy home office. Sarah is diligent. She saves every receipt, carefully tracks her freelance income, and faces tax season each year with a mix of dread and determination, determined not to let anything slip through the cracks. But in 2025, something changed. Her tax bill arrived, and it was thousands of dollars higher than ever before, even though her income and lifestyle hadn't changed at all. She pored over her records, double-checked every number, and scoured her paperwork for errors, but there were no mistakes. The problem? The rules had changed, quietly and without warning. This wasn't a headline-grabbing new law, but a hidden tweak buried deep in the tax code, a technical adjustment that blindsided people like Sarah who thought they were doing everything right. And Sarah isn't alone. Across America, millions of people are opening their tax bills to find unexpected increases, victims of a system so complex that changes can detonate years after they're passed, catching everyone off guard. These aren't just minor tweaks, they're fundamental shifts in how income is counted, what expenses can be deducted, and how much money stays in your wallet at the end of the day. The culprit isn't a single villain or a dramatic new law, but a tangled web of technical adjustments and obscure provisions with massive real-world consequences for everyday people. Understanding these hidden rules has become a survival skill, one that can mean the difference between financial stability and a nasty surprise come tax season. So, what exactly happened to Sarah, and what could happen to you? Let's dig into what's really going on behind the scenes. The monster behind Sarah's pain? Section 174. It's a little-known provision in the tax code, but its impact is anything but small. For many business owners, it's like a trapdoor that suddenly opened beneath their feet, threatening the very foundation of their companies. For decades, companies could deduct all their research and development costs in the same year, fueling innovation and hiring. This policy helped American businesses take risks, invent new products, and stay ahead in a competitive world. It was a key reason why so many breakthroughs happened here, from life-saving medicines to cutting-edge technology. But a change buried in the 2017 Tax Cuts and Jobs Act now forces companies to spread those deductions over 5 years, or 15 if the research is overseas. This obscure rule didn't make headlines, but it quietly rewrote the math for thousands of businesses. This isn't a minor accounting tweak, it's a massive immediate tax hike on innovators. Suddenly the cost of developing new ideas skyrocketed and the financial risk of failure grew even steeper. Imagine spending $10,000 on tools, but only being allowed to deduct $2,000 this year. The rest over the next 4 years. That means you're out the full amount now, but you can't get the tax relief you need when you need it most. Your cash is gone, but the IRS pretends it's still there. This disconnect puts a real squeeze on business budgets, making it harder to pay employees, invest in growth, or even keep the lights on. This creates real cash flow crises for businesses, not just tech giants but manufacturers, software firms, even breweries. It hits every corner of the economy, from the smallest startup to established companies trying to stay competitive. About 20% of the US economy is hit by this rule, stifling problem solvers everywhere. The ripple effects are felt in every community, as fewer resources mean fewer opportunities for everyone. Congress agrees it's a bad idea, but gridlock keeps it in place. Lawmakers on both sides have called for a fix, but political battles have left businesses waiting for relief that never comes. In 2025, companies are still stuck with this flawed system, and the fallout is spreading. Each year it remains, more businesses are forced to cut back, delay projects, or even shut down. The result? Less innovation, fewer jobs, and higher costs for everyone. The American dream of building something new is slipping further out of reach. Let's see how this business problem becomes your problem, because when innovation slows, we all pay the price. You might think, that's tough for companies, but why should I care? When businesses face surprise tax hikes, they pass the cost to you, through higher prices, fewer jobs, and less innovation. First, prices rise. Companies cover new tax bills by charging more for products and services. Second, layoffs increase. Since 2023, tech has shed over 500,000 jobs, with Section 174 a hidden driver. Third, innovation slows. Risky long-term projects get shelved because the tax hit is too steep. The result? You pay more, job opportunities shrink, and the future gets less exciting. This isn't just a corporate issue, it's a stealth tax on your household. The business's problem is now your problem, showing up in your bills and your community. The ripple effects are everywhere. Let's look at how this hits your local economy. The pain doesn't stop at the company's door. The impact of this tax rule ripples through your entire community. When a big employer cuts jobs, local coffee shops, diners, realtors, and builders all feel the pinch. Fewer workers mean fewer customers, and small businesses, the backbone of towns, start to struggle. Layoffs at one company can trigger a second wave of job losses across local businesses. Small and medium-sized businesses are hit hardest. A surprise tax bill can threaten their survival. They're forced to choose between paying staff and paying the IRS. This stifles entrepreneurship and makes it harder for new businesses to grow. As investment and hiring slow, local tax revenues drop, threatening public services like schools and parks. What started as a technical change in Washington now affects your roads, your schools, and your neighborhood's vibrancy. In a complex economy, no change is ever truly small. The tax code's hidden traps are closer to home than you think. Now let's talk about the IRS's magical thinking about your time and money. The IRS claims many of its forms cost you nothing to complete, an absurd fiction. In 2025, the IRS labeled 392 forms as having zero out-of-pocket cost, often because they haven't figured out how to measure the burden. Americans spend over 7 billion hours and $148 billion a year just on tax compliance, more than the GDP of some countries. By pretending these costs don't exist, the IRS hides the true burden of its complex system. This zero-cost myth lets policymakers pile on new rules without accounting for the real-world impact. You know the cost isn't zero when you spend hours or pay a pro to file your return. The system's complexity is a hidden tax all its own. Take Form 1099-B for example, the dreaded form for reporting investment sales. The IRS says it costs you nothing, but complying with it takes Americans 2.2 billion hours a year. Many hire professionals just to avoid mistakes, paying real money for zero-cost paperwork. Others try to DIY, risk errors, and face penalties or overpaying taxes. The real burden is in record-keeping, tracking every purchase date and price, sometimes decades old. The IRS puts the burden of proof on you while pretending it's effortless. This isn't just an insult, it's a dangerous fiction that hides the true challenge of tax compliance. The complexity punishes regular people just trying to save for the future. If you have money overseas, the IRS has a special trap for you, the F-bar. If your foreign accounts total over $10,000 at any point, you must file a separate report or face huge penalties. Many people, especially immigrants or those with family abroad, don't realize this rule exists. The penalties are brutal, up to $10,000 per violation for honest mistakes, and up to 50% of your account balance for willful violations. Thanks to international agreements, foreign banks report your info directly to the IRS. The agency uses advanced analytics to hunt down non-filers. In 2025, a Florida woman was sentenced to prison and millions in penalties for hiding foreign accounts. The same rules apply to everyone. Ignorance is no defense. The F-bar is a costly trap for the unwary. The IRS has plenty of smaller ways to squeeze taxpayers. Every paid tax preparer must pay a $19.75 fee for a P-10, costs that get passed on to you. With over 822,000 preparers, that's $16 million a year in fees, baked into your tax bill. The IRS's direct file program, which lets some people file for free, may be canceled, pushing more into costly software or paid help. Even inflation adjustments to tax brackets often lag behind real living costs, so families still feel squeezed. Hidden fees, disappearing free options, and slow adjustments all add up. The tax system's complexity and costs keep growing. It's death by 1,000 paper cuts. Feeling overwhelmed? You're not alone. Tax season can feel like a tidal wave of forms, deadlines, and confusing rules. But with the right approach, you can take control and protect yourself from costly mistakes. Don't panic, there are ways to protect yourself. First, get organized. Start by gathering all your important documents early, and create a dedicated folder for tax-related paperwork. This simple step can save you hours of stress later. Track income, expenses, and investment cost basis all year, not just in April. Keeping a running log helps you spot errors and deductions you might otherwise miss and makes tax time much less daunting. Use software or spreadsheets to stay on top of records, especially if you have investments or a small business. Many apps can even alert you to deadlines and help you categorize expenses for maximum deductions. Second, consider hiring a qualified tax professional. An expert can help you navigate complex rules and provide peace of mind that your return is accurate. Yes, it costs money, but it can save you from costly mistakes and missed deductions. Think of it as an investment in your financial well-being, especially if your situation is complicated. A good pro knows the latest rule changes and can help you avoid IRS traps like Section 174 and FBR. They'll also help you plan ahead for next year so you're never caught off guard. Third, educate yourself and advocate for change. The more you know, the better you can protect your finances and your future. Pay attention to tax policy debates. They affect your wallet. Changes in the law can impact your deductions, credits, and even how much you owe. Support groups fighting for a simpler, fairer tax code. Join local organizations or online communities to stay informed and share resources. Contact your representatives and demand repeal of harmful rules like Section 174 amortization. Your voice matters. Lawmakers need to hear from real people affected by these policies. Protecting your money isn't just about your own return, it's about pushing for a system that's fair and transparent. When we work together, we can make a difference for everyone. Be vigilant, be prepared, and don't let hidden rules take more than they should. Review your return carefully and double-check for any changes that could affect you. The tax code is complicated, but you don't have to face it alone. Reach out for help and support others in your community who may be struggling too. Stay informed, stay proactive, and keep more of what you earn. With the right tools and support, you can survive and even thrive during tax season.